Insightful Value here with a fresh deep dive into why Selective insurance stock is trading low and whether that might signal opportunity. This review is for informational and educational purposes only, not financial advice. Please subscribe to the channel and hit like if you find this helpful. Today's date is July 25th, 2025. Selective Insurance Group, ticker SIGI, is a property and casualty insurer offering commercial, excess and surplus, and personal lines through independent agents. From a value analysis lens, it delivers consistent underwriting improvement, rising investment income, and solid return on equity. But the stock has lagged expectations. In the first quarter of 2025, net income per share was $1.76, up 34% year over year, though it missed consensus by about 10 cents. Net premiums written rose 7% and earned premiums grew nearly 10% as renewal rate hikes averaged 10.3%. The company lowered its combined ratio to 96.1% from 98.2%, signaling better underwriting discipline, and return on equity rebounded to 14.4% from around 11% in 2024. Investment income rose 12% to roughly $96 million, boosting financial strength, while book value per share increased 5% to about $50 and adjusted book value reached $53.40. Selective paid dividends consistently, continuing over 50 years of payouts, though the yield remains modest around 1 to 2%. Why is the stock down then? Despite encouraging results, analysts remain cautious. The company fell short of EPS estimates, projections have drifted down, and policy renewals in standard personal lines declined meaningfully by about 12% due to profit-first rate actions. Workers' compensation underwriting weakened sharply, with that segment posting a combined ratio over 105%, and the industry continues to face social inflation and reserve risk. Long-term debt rose by nearly $400 million, raising leverage concerns. Over the past year, the stock dropped around 20% and recently hit its 52-week low, with market sentiment muted despite the underlying recovery in fundamentals. Zacks ranks SIGI a hold with limited upside potential in the short term. So, what's the bull case? Improved pricing, favorable prior year reserve development, stronger underwriting, and a recovering ROE point toward a potential re-rating if earnings continue to beat and loss trends stabilize. But why not now? If inflationary claims pressures persist or growth in premium volume remains weak, momentum may stall. In summary, Selective Insurance is not broken. Its core business shows signs of resilience and improved profitability, but stock sentiment lags results. For disciplined value investors looking for an insurance name with improving margins and modest valuation, it may be worth watching. For more perspective on SIGI and other undervalued companies, visit InsightfulValue.com. Our aim is to break down complex data into clear takeaways without the jargon. Thanks for tuning in. Don't forget to subscribe for more deep dive value analysis and head over to InsightfulValue.com for even more insights.